Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 250 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think can be useful for you in your long-term financial journey. Today, we are going to be talking about the stock market, and specifically the fact that many think that the stock market is rigged. And I'm going to talk about that, give my 2 cents, talk about what I think about the current conditions of the stock market, and really give you a pretty good case as to why many may think the stock market is rigged. And so stick around for all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things that I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over a long period of time, then I can help you do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And in those sessions, you and I can begin working together, creating financial goals for you and your family that are specific to you and that you can attain. And the attaining of those goals can help you to push towards long-term financial freedom, which is what I hope for every single individual who watches or listens to this show on a day-to-day basis. So many times I have heard, and maybe you have heard it as well, the argument that the stock market is rigged. And people give different reasons for why they think the stock market is rigged. And I found maybe one of the best reasons just recently. There's something that's been going on in the markets for a long period of time now, and specifically since the last financial crisis, that I think is a bit alarming, right? And if you just look since the coronavirus crash, we've seen it really accelerate in the way that it's occurring, and that is the increasing in the Federal Reserve's balance sheet, okay? And not just the increasing in the Federal Reserve balance sheet, but that increasing in the balance sheet and the movement of the S&P 500 or the stock market. I think these two things, they should not be as inextricably tied to one another as they are. Now, the first thing that we need to understand is the Federal Reserve, what the Federal Reserve is, what the Federal Reserve does. Right? The Federal Reserve is the central bank in the United States. So what do? They set the monetary policy, and their mandate is twofold. It's to keep stable prices and to maximize employment. Okay? And so in times of crisis, you can see how the Fed would be extremely important to the market. Now, maybe not just in times of crisis, but the Fed is always very important to the market. Now, why is this? Well, in keeping with stable prices, what the Federal Reserve does and what the Federal Open Market Committee does, which is a committee of 12 of the most powerful individuals when it comes to money and finance in the United States, what they will do in trying to keep stable prices is they will set interest rates, right? And not just every interest rate. They're not going through and setting every single interest rate like the interest rate you would get on a home loan or a car loan or a credit card or whatever, right? But they are setting the base rate by which all those other rates are determined, called the federal funds rate, right? And this is the rate at which banks can lend to one another overnight, and then subsequently those banks lend to you and they offer you some premium above that federal funds rate in order to make money on the funds that they've already borrowed, right? So that is what the Federal Reserve does as far as monetary policy and setting interest rates for stable prices. But something that they will also do is they will also stimulate the economy in different ways, and they can do so by repurchasing bonds from the market. And obviously when they purchase bonds from the market, what occurs? Money flows into the market, right? So that stimulates the market, and that's something that they have been doing in the wake of the coronavirus crash, right? They have been buying all of these securities, all of these bonds, all of these bond ETFs, all these mortgage-backed securities, all these different things, right? And it increases their balance sheet. Okay, but it pumps money into the economy. And when you pump money into the economy in that way, it is stimulating. Now, they can also not just buy bonds from the market, but they can also sell bonds to the market. And in doing so, they can shrink their balance sheet. And in doing so, they can tighten monetary policy. They can tighten the policy that is impacting the growth of companies in the market. Okay, so they have a whole lot of power, and they have way more powers than that. But those are two major things that I want you to understand that they do. Right. And something that they're really worried about, at least right now, at least this is what they say that they're worried about. They're worried about getting back to the point of maximum employment, right? Because part of their mandate is maximum employment, right? So they're worried about getting back to this point. Well, the coronavirus pandemic, it displaced a lot of workers and it led a lot of people out of the traditional labor force, right? It's led a lot of people to start their own businesses and do different things that they wouldn't have done otherwise, right? So this, unemployment rate that we're currently looking at may not be indicative of the actual unemployment rate. And especially with a lot of stimulus money going towards unemployment benefits being enhanced, meaning that some people were making more on unemployment than they would going back to working the job that they work, okay? So it's a very big topic when it comes to financial markets on a day-to-day basis, because anything that the Fed does and anything that the country does and Congress does that either stimulates the economy or doesn't stimulate the economy, right, goes the other way, it will impact financial markets. And that's really what I want to get to today, and what I want to talk about is because when I talked about purchasing bonds, right? The Fed purchasing bonds from the market, purchasing bonds from the open market to hold on their own balance sheet, right? If you look at the size of the Fed's balance sheet, right, and you just overlay the Fed's balance sheet with the S&P 500, obviously they are in different values, but you do so from 2010 to today. Okay, that overlay is very, very interesting. Now, do they go one for one? No, they do not go one for one, right? But as you see the Fed's balance sheet grow, you see the S&P 500 go up, right? And as you see the Fed's balance sheet shrink, you see some rocky times in the S&P 500. But then as these bond repurchase programs have really spiked back up, then you see big spikes in the S&P 500. So the question then becomes, is the market just rigged? Is the market just based on the Fed holding up the economy, holding up markets? And my argument for this would be that the Fed is not doing everything. Okay, the Fed is not making life-changing decisions when it comes to the stock market. But I can guarantee you this: without the Fed, the Fed keeping interest rates low as they have for the past 11, 12, 13 years, right? Without them doing that, without them adding a bunch of money into the economy via their balance sheet, right? Via just printing money. When they say printing money, that's what they're talking about, right? The Fed, any money that they give into the market is just money that is printed. It is just new money that is put into circulation, right? And so the Fed puts all this new money into the economy, and as they have done so, the stock market has risen and risen and risen. And why is this, right? Why is it the fact that as money is pumped into the economy and as money is cheap, right? Yeah, that's another part of it with low interest rates, right? Keeping interest rates low keeps money cheap for corporations, right? Corporations have low interest rates at which they can borrow money, and consumers have low interest rates at which they can borrow money, which really is a double whammy for markets, because corporations can borrow cheaply, meaning they can get money to grow that is very cheap to repay, and so they'll gladly do that, right? So they can take out a lot of debt that is really, really cheap, and consumers can take out cheap debt and buy a lot of the products that companies offer, right? Which again can push the S&P 500, which can push the stock market as a whole up and up and up. And there's even this saying in the market that goes around, and it's "don't fight the Fed." Okay, basically meaning don't bet on the market going bad if the Fed is going to constantly be there to pick the market up. And you see some of these graphs, some of these charts, some of this data, and you really find out that, yeah, you don't want to fight the Fed, right? You don't want to be on the wrong side of this cycle. And what this causes is an inflationary economy. What the Fed is doing, what the Fed has done, leads to an inflationary environment. Okay, now we are at a point today where We just saw a new inflation reading this past week, and it's at 5.4% annualized for this past month, right? Which is higher than we've seen it in my lifetime, right? Inflation has spiked, but the Fed's balance sheet spiked, right? If you go back to last year, before the coronavirus pandemic hit us, right, you were seeing this tapering, this declining in value of the Fed's balance sheet. They were actually letting some bonds roll off of their balance sheet. They were getting a smaller balance sheet. Now, what that smaller balance sheet led to, right? It led to in 2018, towards the end of the year, the stock market had a pretty rough time. And then obviously the coronavirus pandemic, the stock market had a really, really rough time. Okay. And maybe it led to the coronavirus crash being as bad as it was. But monetary policy immediately stepped in, and it spiked in a very, very large way, in a way that we haven't seen at least since the financial crisis. And even during the financial crisis, we have to think about what the Fed and the Treasury were trying to do. They were trying to get things passed for hundreds of billions of dollars. Now we're talking about trillions and trillions of dollars, right? The Fed's balance sheet went from, somewhere in the $4 trillion, $4.5 trillion range to now we are sitting over $8 trillion on the Fed's balance sheet, and it's expected to go over $9 trillion before they stop tapering, or before they're done with their open market repurchases of bonds, right? So this is just a huge deal. And many think that this is just propping up the stock market, that it's just propping up our economy and not allowing it to go through natural cycles of boom and bust. A lot of people even say that the correction is no longer in our vocabulary, or that the bear market, like we had seen in the past, is not in our vocabulary, because the coronavirus crash, if it had happened, let's say 50 years prior, I have no doubt that it would have lasted a lot longer. Okay. And if even the financial crisis, right, the crash of the financial crisis, if it would have occurred 50 years earlier, I have no doubt that it would have lasted a lot longer before we got back to points of significant growth in the S&P 500, in the stock market as a whole. Right? I have no doubt of that. And corrections as we currently see them, like back in 2018 or 2015 and 16, right? Corrections, not only are they happening less often, right, but they are happening so fast that if you just hold on for a few weeks or maybe a month or two, you're going to be perfectly fine in the market. Okay. So this acceleration of the market is done by the fact that there's just money just pumped in and pumped in and pumped in. All of these recessions, all of these corrections are happening so much quicker. I saw a stat recently. There's a couple stats I want to give you guys, and some of the stuff is just absolutely crazy. But there was a stat that I saw recently talking about bear markets and how long it took from the beginning of that bear market cycle to the stock market getting back to that point, right? How long it took for it to drop and then dig itself out. And the shortest periods of time for any bear market in the S&P 500 over the past 100, 150 years, right, as long as we can keep up with the S&P 500, right, have been the coronavirus crash, right? It was the fastest that we've come out of one. And then the financial crisis was actually the second fastest that we'd come out of one. And that is really interesting, right? The coronavirus crash, I think, is one thing because it really shifted the economy and it shifted the types of companies that were going to do well during that time, right? But the financial crisis had a pervasive impact on just about everyone. Right? Just about every single company, there was some issue. There was some trepidation. Consumers were scared. Consumers had lost their jobs. Consumers didn't know what to do. Liquidity had dried up at the banks, right? So this really impacted the entire economy and not just certain sectors because, you couldn't go outside like during the coronavirus crash, right? So you would think, given that it is the Great Recession, that it would have lasted quite a bit longer as far as a bear market goes, but it didn't. Right? It didn't last that long. And that is pretty interesting to me. That's pretty alarming, maybe even, because we have this acceleration of markets. Markets have accelerated, and they have especially accelerated as we've seen more money pumped in by the Fed, as we've seen interest rates stay lower. Right? These things have caused these corrections to happen very fast, these bear markets to happen very fast. And that can be pretty concerning because just as fast as you can go up, you can also go down. But it's kind of nice to know. I think a plus side to all of this I mean, it's nice to know that the Fed has your back, right? If you've been an investor the last 10, 11, 12 years, I mean, you've done exceedingly well. You've made outsized returns in the longest bull market that we have seen in the S&P 500, as long as there have been stats on the S&P 500, right? And that particular bull market was yielding you some very, very good returns. And the Fed was behind that. The Fed did keep interest rates low. The Fed did keep a lot of those bonds on its balance sheet, even if it wasn't actively purchasing all of the time, right? So I think this is something interesting. Now, do I think that this is driving everything that goes on in markets? Absolutely not, right? I don't think that the market is truly rigged. Okay, I've made a pretty strong argument to this point, but I don't think the market is truly rigged. Do I think the market is and can be propped up? Absolutely, right? I think that there are a lot of things that can happen in markets and probably should happen in markets that don't, right? There are a lot of companies that do very, very well that shouldn't. Okay, I think that some of the companies out there that have very little in the way of revenues or revenue growth, or don't have any earnings, and yet are given these outsized valuations, that's probably irresponsible, and it's probably because there's way too much money out there to invest in companies like this, right? Do I think there's some great companies that create cash flow and do really good things and provide value to shareholders? Absolutely, right? But I don't think that all companies are that. And I think that Fed interference, I call it Fed interference, or the Fed stepping in, or the Fed keeping interest rates low or increasing their balance sheet in the way that they have, yes, it 100% helps the great companies, because the great companies are like, yeah, I'll borrow cheaply and I'll take advantage of the stimulus that investors are getting, or the stimulus that the consumer is getting. I'll take advantage of that as a company, right? But it also helps those companies that are really cruddy and aren't very good and don't have a lot going for them, because even they can raise money in times when money is so easy to get your hands on. Okay, now, what makes me really think that the stock market is in a place that it's really never been before, right? And how can we think about this Fed interference when it comes to the broad spectrum of what's going on in the market over a long period of time? Well, I look at ratios, right? Financial ratios. That's just part of financial analysis. You'll look at financial ratios. And one such financial ratio that I think is, if you're an investor and you don't look at this, then you're missing the mark. But it has become less and less valuable to us, especially in the last 20 years, right? It's been less and less valuable to us than it has been in the previous 100 or 120 years, especially when you're looking at the S&P 500, and that is the price to earnings, or PE ratio, right? The PE ratio is nothing more than the stock price over the earnings per share of a particular company. Now, you can also do it for the entire market, where you're taking the price of the S&P 500 and dividing it by the per share earnings of the entire index. Okay, so that's what they've done. That's what I'm looking at here. And what we see is that currently the PE ratio of the S&P 500 is 46.32. Okay, now Robert Shiller also has a PE ratio that is adjusted for some different things, adjusted for cyclicality and different things like that, and he has it at 38.27. Okay, now that you're like, okay, well, what does that even mean? How do I compare that with history? Well, with history, you can compare and you can say, okay, it's extremely high relative to history, because the average PE ratio on the S&P 500 over time, right, since the late 1800s is 15.98. And if you look from the late 1800s until the 1990s, right, or maybe even the early 2000s, but really the late 90s, right, you can look and say that the PE ratio of the S&P 500 was really range bound, right? It was really range bound between, it would get as low as, 5 back in the Great Depression. That was really, really low, but typically about as low as, 7, 8, 9, 10, and then up as high as 20 to 25 at the high point, right? And so the PE ratio really stayed in that range. But in the late 90s and then into the 2000s, and you got to the point of the Great Recession and all these different things, you saw some really inflated PE ratios. And to this day, you still see some very, very inflated PE ratios, right? 46.32 relative to the mean of 15.98 and relative to the median of 14.86. Okay, so this is a very, very big deal. What it means is that markets are very expensive relative to their earnings. So what does that mean, right? That means that the prices of the stock market, right, the prices of companies in the S&P 500 are very high historically relative to the amount of money that they earn, right? The amount of money that they earn on a regular basis. Now, why is this useful? Why do we care about this? Because this can tell you how overvalued or undervalued something is, right? The PE ratio is telling you how much you are paying for $1 worth of earnings for a particular company or for a particular index. And the higher it is, the more expensive it is to purchase these particular companies. And so this tells us that the market looks, at least on the surface, very overvalued. But if we are talking about what the Fed has done and what the Fed continues to do, nobody is going to fight the Fed as long as they continue to provide the stimulus that we like to see, as long as they keep rates low and as long as they continue growing their balance sheet. Okay, which really brings us to talk, at least currently, about why investors get so worried about inflation. Because as inflation gets hotter and hotter, there becomes a push to do something about it, right? Because if inflation gets too high, obviously there can be some really bad impacts on consumers, right? Consumers won't be able to pay for anything, right? If inflation gets too high, which is problematic, and wage growth doesn't keep up with the prices of goods and services. Okay, so when inflation gets higher, then the Fed has to step in and do something, right? The Fed has to step in and they have to raise interest rates, or they have to slow down their repurchasing of bonds from the market, right? And in doing so, what that does is that slows the amount of new money that comes into the market, and it slows the rate at which companies are just borrowing money and borrowing money and borrowing money, because now it's more expensive to borrow that money. Okay, so with this money being very cheap, with the Fed continuing to pump money into the economy, valuations do get high. Price to earnings ratios do get high. Consumers get a lot of money in their pockets and they maybe don't need it, right? A lot of people got money that didn't need it. I'll admit to you, I got stimulus checks. Me and my wife got stimulus checks, and we didn't have to get stimulus checks. Nobody lost their job. Nobody was in a place to have to have money given to them, but we got stimulus checks. And guess what? A fair amount went into the market, right? A fair amount went into our investing. And so when a lot of people get money in their pocket, so investors get money in their pocket, companies get money in their pocket, all that's going to do is that's going to push valuations higher and higher. And as long as nobody fights the Fed, valuations will remain high. But the question becomes, when does it get popped? When do valuations fall back down to earth? Because not only are we high on earnings, right? We're really expensive relative to earnings. The market is also really expensive relative to even sales, right? In a similar way to earnings, it's been kind of range bound over a long period of time, but it's at a historic high on price to sales at 3.2, and the average over the long term has been 1.62. Okay, so basically double the average is where we're at as far as that valuation metric. Or then you look price to book value, the book value of a company. Now, with that one, we're not at our max. You were at the max back in 2000, but relative to the mean, we are still very high. 4.7 is the price to book value of the market right now relative to a mean of 2.89. Okay, so all of these things point to an overvalued stock market, and the reason that the stock market is at such high valuations is because there is so much cheap money and so much free money that's been given to the market, that's been given to companies. Because let's make no mistake that yes, individuals like myself got money from the federal government that didn't need that money, but companies are also getting money who didn't need that money. Okay, and all this money that the Fed is just printing, and this Fed balance sheet, this these liabilities that the Fed is holding that just keeps increasing and increasing and increasing, it is a very, very big issue. Now, does any of this mean that I'm fear-mongering? No. Does this mean that I want you to understand what's going on in the market right now? Absolutely. Right? Again, I'm not going to fight the Fed. I'm going to keep investing. I'm going to keep putting money away systematically. I am not afraid to continue to do so because we've seen high valuations before. And what's the worst thing that can happen? The worst thing that can happen, the market crashes, right? It comes back down to earth. Valuations come back down to earth. We see some corrections. Things come back down. And if that were to occur, then I will just keep buying and keep buying and keep buying, because a couple reasons. One, as long as the Fed has your back, why would you want to fight it, right? Why would you want to try to, do something crazy if the Fed's going to continue to do what they're doing? Okay, but on the other hand, right, even if the Fed stopped, backstopping the market, then bad companies are going to fall out of indexes and good companies are going to get in, right? And you're going to continue to have this cycle where you're going to be able to make money over the long term. Now, is it sustainable to continue doing what the Federal Reserve is doing in our markets today? Probably not. Okay, but hopefully they know that. And let's not forget that there are other underlying reasons that this can be occurring, right? The Fed could be increasing its balance sheet and allowing inflation to run a little hot and all these types of things to make our debt less costly in the market, right? Because if you have increased inflation and you have these bonds outstanding that other countries like China owns or like Russia owns or whatever, right? They own your bonds and you're paying them some fixed payments over time and then ultimately returning principal to them, right? They own all of your debt. Then if you just increase your money supply, your monetary supply, then the value of that debt declines because you're paying them some fixed amount of dollars, right? You're paying them a fixed amount of dollars, but the value of the dollar is declining. And if the value of the dollar is declining, then what they're getting paid is worth less and less and less. Now, again, this is not a sustainable thing to do, but it is something that federal governments do and that central banks do in order to make sure that other countries aren't going to be able to just tell them what to do based on the fact that they own their debt. Okay? None of this is good. None of this is perfect. None of this is ideal. Right? Because just in the same way that I tell you that debt is a bad thing for an individual, it's a bad thing for a country when overdone as well. And so I don't want you to think that we're just in this good place, because when you're requiring so much federal stimulus, or when you're just getting so much federal stimulus that you're not supposed to be getting or you shouldn't be getting over a long period of time, there can be consequences. And one of those consequences is that the stock market starts to look really rigged. The stock market starts to look really frothy. It starts to get really high in valuation. Again, I am not going to stop investing, and I don't expect you to stop investing either. But let's just ask ourselves a question for just a moment, right? I'm just going to go back to last year, and I'm pulling up a chart of the S&P 500, and I'm just going to go back to the bottom last year, March 2020, right? March 20th of 2020 to today. Okay. And if you look at that increase in value, the stock market has increased 89.16% since March of last year. And you may say, well, it fell too much in the first place. Maybe you're right. So let's just say from the top before the market crashed, right? So we'll go to February 14th of 2020, okay, and take it all the way to today. And then what you have there is a return of 28.99%. So let's say that the coronavirus crash didn't happen. In the past year and a half, the S&P 500 would have made 29% when we were already towards the end of a long bull market, right? And a 29% year and a half is outrageous, right? That's a crazy good year. That means that on an annualized basis, you're making almost 20% annually. Right? That is a huge, huge deal. And so is it really worth what it's trading for today? I'm not trying to get you to stop investing. I'm not trying to get you to stop putting money in, because I definitely want you to keep putting money in and doing so systematically. So even if it does crash, you can get good prices and it can continue upward. And over the long term, it has only continued upward. So I don't want you to be fearful of continuing to invest. I just want you to know the facts. The facts are the Fed has pumped a lot of money into our economy. The Fed has kept rates low for a long, long time. And it's pretty scary when you look at the Fed's balance sheet and the movement of the S&P 500 and how tied together those two values are. And you really see it for the first time. You're like, wow, this has some real impact on our stock market. It has some real impact on the value of my money moving forward. So it's important to know that. And it's also important to know that even if multiples come back down, even if the market comes back down and does so in a very violent, real way, that we should keep investing, because America's best will continue to do better over the long term. Even if inflation's going to run high, even if the Fed is not going to move fast enough, we can't sit here and sit on the sidelines. We have to be putting money to work and allowing it to work in the place that it has worked best over a long period of time, and that is in the S&P 500, which is why I talk about buying S&P 500 index funds all the time. Okay, so don't let me scare you you. Don't let me fear monger you. Okay. But if you wanted to make an argument for the S&P 500 being rigged, you might have a point. So thanks for watching this episode. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things that I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching, and you and I can begin working together, creating financial goals for you and your family's financial life, and pushing you towards those goals over the long term, and then ultimately getting you to some point of long-term financial freedom. So tune in Monday as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.